So, as I was saying, we started with the theoretical background of group accounts, saying that it arises as a result of intercorporate investment, and we looked at those types of investment from investment in subsidiary, associate, financial assets. We looked at the standard we'll consider. Then we move to introduction to investment in subsidiary, power rights. We explained a lot of things. Oh, yes, last two weeks or last week, yeah. And also, we then moved to accounting, that when an entity has investment in subsidiary, it must prepare consolidated financial statements. And before he does that, we said he should consider potential voting rights, exemption from preparing consolidated, exclusion of a subsidiary, uniform accounting policies, uniform reporting dates. And we also looked at this very important part. We talk about parent separate financial statements. That when you have a parent separate financial statement, that's in addition to preparing consolidated, that a parent also prepare his own separate financial statement, and it is in his own separate financial statement that investment in subsidiary he bought, he will account for it at costs, sometimes in line with IFRS 9 and all of that. And I also mentioned that where the parent takes advantage of exemption from preparing consolidated financial statements, as mentioned above, he needs to make certain disclosures. I gave you these four. And you need to know it because I can ask it in the exam. So you really, really, really need to know all these theoretical backgrounds. Then we jumped into basic consolidation procedures. So, and this is for investment in subsidiary. I hope you know that where the parent is required to prepare consolidated financial statements. And I told you that this consolidated financial statement is prepared using a consolidation method. And it involves canceling out similar items that appear as assets in the books of the parent, and the ones that appear as equity or liability in the books of the subsidiary and vice versa, they are cancelled out. And whatever item that is not cancelled out, you can then add those ones together. So I gave you examples of items that are cancelled out, majorly investment in the subsidiary against equity in the books of the subsidiary. So they are similar items, they cancel out because when a parent invests in a subsidiary, he will put it in his own books as investment in the subsidiary, while in the books of the parent, while in the books of the subsidiary, that will be represented by equity. So they are the same thing. You'd cancel them out. You would cancel them out. And also there could be trade receivables in the books of the parent and trade payables in the books of the subsidiary and vice versa. And if this is arising from transactions between the two of them, cancel them out. That's basically everything we're going to do. And you will even find out later today, in fact, today, that where there are transactions between the two of them and one of them makes profits, you cancel that profit out because you can't make profit from yourself like that. So we looked at some illustrations, then we started consolidation. In consolidating, first, we read this question. We said, okay, to consolidate, the only similar transaction here is this investment in the books of the parent against the equity in the books of the subsidiary. So we canceled out this 60 against this 60 because they are similar transactions. So 40 plus 20, that was what the parent acquired, and he paid 60 for it. So we canceled them out and we added the other ones together. That was all we did. So, which was this. We move to the next one. We read it and we saw that this one has more than one items that are similar. First, we canceled out this 20,000 against this 20. And I explained that ordinarily it should be this investment in subsidiary should be canceled out against the equity of the subsidiary, because what you are actually buying is the equity of the subsidiary at the date of acquisition. However, this 95 was excluded majorly because we acquired the subsidiary since incorporation, meaning when the subsidiary started. And at that date, the retained earnings of the subsidiary will definitely be zero, because it's not possible for somebody to have retained earnings at the date of incorporation, the date you are starting. So it's definitely zero. So that was why we excluded this 95, because it doesn't relate to this 20,000. It's not similar transaction with it. This 95 was generated post acquisition, after acquisition. So they are definitely not the same thing. Then we had to cancel out this 20 against this 20 alone. We then proceeded to these receivables, ESCO. We canceled out this 1,000 since they told us is receivables from ESCO. We canceled it out against we canceled these receivables in ESCO against the payables, yes, of 1,000 also. So because they are similar transactions. What again? And that was all. That was all we canceled out. And every other thing was added together. And that was what we did for that as well. Then we move to the next question. For this one also, we acquired it since incorporation, but the 40,000, we canceled it out against this 40,000. And the reason we didn't consider this retained earnings is the same explanation. Ordinarily, we should consider the whole of the equity. And remember that the equity we are considering is the equity at the date of acquisition. But since this parent acquired the subsidiary since incorporation, that means at the date we acquired the subsidiary, there was no retained earnings. So this 14,000 is post-acquisition. It's after we acquired the subsidiary. That was when he had this 14,000. So we cannot possibly cancel it out against this. They are not similar transactions. They are different transactions. So that was why we ignored. So we only canceled that 40 against 40. Also, the parent also bought debts in the subsidiary. So we canceled out this 10,000 against this 25. So since we didn't buy the whole of the 25, we only bought 25%. So just cancel out 10 against you just take out 10 out of this. So that means remaining 15 will be consolidated. And that was one. Also, we had current account with ESCO against current account with PICO. Those are also clearly similar transactions that should be cancelled out. And I explained that current accounts are used to record transactions between the parent and the subsidiary. That's what current accounts are used to record. Transaction between the parent and the subsidiary, or transaction between members of the group generally. So in this case now, they are not the same, but the question already told us that the difference in the current account is because of goods in transit. Because ordinarily they should be the same. Because if you consummate transactions between one another, as you are recording an amount, the other guy should record the same amounts on the opposite sides. But this is not the same, because apparently this guy has sent some goods. That was why he wrote that, you are saying you are owing me 9,000. But this one is saying, no, I'm still owing you 6,000 because I have not received the 3,000, of course, which is the difference. He said he has not received it. So when we're canceling out, we cannot cancel out the whole. We are only going to cancel to the extent of the transaction that has been consummated, which is the 6,000 against the 6,000 here. So the balance of 3,000 here, you will call it goods in transit. We cannot say that is a similar transaction yet because they have not consummated it. So we still leave it, and perhaps the goods is outside of the group. So we did not cancel out that entirely. So and we started adding the orders together, adding them together. That was all we did. And I wrote it here. Additionally, we looked at a scenario where a parent only acquired 75% of the subsidiary, and which means that the remaining 25% is belongs to people we call non-controlling interests, who are also owners of the subsidiary as well. So when we're canceling out, because that's really I tend to cancel out here, this investment against only this 20. And be careful. Don't think that you only cancel out this investment against share capital. No, you cancel it out against equity. In fact, I can categorically tell you that this equity in this case is the same thing as the net asset of the subsidiary, because net asset is total asset minus total liabilities. It should give you equity. So the examiner can say it in whatever way. They can call it net asset of the subsidiary. They can call it equity of the subsidiary. Okay. And what you are canceling out is the equity of the subsidiary at the date of acquisition, not after, and which is why we are not canceling out these retained earnings yet. Because as at the time we paid this 15,000, this 5,000 was not there because we acquired this guy since incorporation. It was zero. No one will have a retained earnings when they are just starting. It's not possible, right? So, but here now, when you are canceling out this 15,000 against this share capital, you cannot cancel everything because I've only acquired 75%. If you get 75% of this, definitely going to give you 15 as well. And that means we are going to consolidate the remaining 5, but we call it NCI. But the way we did that cancellation was to get you ready for some complexity that could come in the process of doing this calculation. If you look at it, I told you that the money we paid 15, okay, gets, you should tag along this NCI, which is 25% of the net asset we acquired, which is 20,000, so that we know that this is 100%, then these two completely become zero. However, since we know that this NCI will be consolidated because it's not similar transaction, so we set it up separately. And the reason why we have to do this is to get it ready to also get a share of profit, a share of a lot of things that will come up later. Because these NCI are also owners of the subsidiary. So they get to share profits, they get dividend, they get to share losses, and a lot of other things that will come up. So we set it up separately here. Instead of you just doing cancel out 15 against 20, you now get it as balancing figure. It would affect some of our calculations later. So we said, okay, why not, since it will give us the same thing, why not let's get 100%. Okay, now, okay, who are the people that paid for this subsidy 100%? What did they pay for 100%? Fine. Then let's set up the NCI separately. Don't let it become a balancing figure here. Let's set it up separately. So this value of NCI, I just picked it I got it from here, 5,000. Then it gets a share of the retained earnings of the subsidiary. And not just retained, of course, of the profits that the subsidiary made after acquisition, which is this 5,000 I was talking about. You get a share of it. So you get 1,250. So the total value of NCI becomes 6,250. So whatever is remaining, we consolidate our own retained earnings against our share of it. Okay. So that gives us this. And we're just adding up the remaining. Why, of course, putting NCI under equity and the consolidated retained earnings as calculated above. So it's really nothing much that we did here. Then we went further on a situation where we acquired ESCO on June and we're required to prepare account on June. So here now, they gave us the number of shares we acquired. And you have to sort out yourself to know that, okay, the number of shares the subsidiary has is also 25,000. So that means we have acquired the subsidiary 100%. But when we're canceling out, the only item to cancel out again is just these investments that we paid for against the equity of the subsidiary. Now, in this case now, we can now consider the total equity, which is 30,000, because we acquired this subsidiary on June. And this statement of financial position they are giving us is at June, is at the same date we acquired the subsidiary. That means this retained earnings you are saying was the retained earnings that was there when we acquired the subsidiary. That means this 40,000 we paid, we actually paid it for the equity of the subsidiary. We paid for this 30K. Unlike the ones we have been looking at, where we acquired the subsidiary since incorporation, where the retained earnings will have obviously been zero. So, and what we'll have been paying for will have just been the share at the date of acquisition, because it's only share capital that will be there anyway. The retained earnings will be zero. But now we met retained earnings there, so we'll have paid for it. So when we're canceling out, so we set up the amount we paid against what we acquired, share capital, and I call that retained earnings that was there when we acquired it. I called it pre-acquisition because it's retained earnings that is there before acquisition. So I saw that when I canceled out, it's remaining 10,000. That means we paid above the value of the equity of the subsidiary, and we say we call that goodwill. So whenever we have paid above the equity of the subsidiary at the date of acquisition, that's goodwill, which is not out of place because the guy he believes there is something the subsidiary has that is not that is not captured in the books as assets. So he is ready to pay extra for that. We call that goodwill. So you will see that it shows in the consolidated account because that's the balance that's not cancelled out. And what we just did was just to add the remaining. And when we got the retained earnings, remember that I did not add this 5,000 because it has been cancelled out. So I only added this. I did not add this 25,000 because it has been cancelled out. And we moved further on here. The same principle, we acquired it in June. They gave us the statement in June. So when we're canceling out, we'll be canceling out this 35,000 against this 30,000. But in this case now, we only acquired 20,000 out of 25. And that was the first thing I figured, to know that we only acquired 80%. That means there's remaining 20%. So when I want to do my cancellation, we use that approach that I said, okay, let's compare 100% against 100%. So we look at how much we paid, 35. So this 35 is what we paid for 80%. The remaining 20%, we know that those are non-controlling interest. And to get their value is 20% of the net asset acquired. The net asset acquired, which is the ordinary share capital plus the reserves of the subsidiary. So usually before you calculate this, you must get this first. So after I've gotten this 30K, then I can then determine my NCI. So it gives me 41,000. So 41,000 minus 30 gives me 11. So which is goodwill. Then I can then get value of my NCI, which is 6,000. And that was really it. However, you see this approach we use there to determine these NCI values, the examiner will call it proportionate share of subsidiaries' net asset. So you are valuing this NCI based on his share, based on his holding in the net asset of the subsidiary. And I think the examiner mentioned it, that NCI is measured at proportionate share of the net asset of the subsidiary. Then we just consolidated, adding other things together, the goodwill we have computed, the NCI, and all of that. We put all of those together. Then we now looked at another question where they say we should measure the NCI at full fair value. And that is a scenario whereby you would need to get the number of shares the NCI acquired. You would then multiply it by the share price of that subsidiary. So using the market, it's like using the market value. So now I've seen questions asking you this, that, okay, what's the net assets? Calculate the NCI using proportionate share, or calculate NCI using um, um, full or fair value. It's very straightforward. So, and what we did there is when we're canceling, again, we only acquired 20 out of the 25,000 shares the subsidiary has. And since the date of acquisition is June and the date this account was presented is June, that means this retained earnings is pre-acquisition. So that means the total equity is what we are paying for. So when we're canceling what we paid, the NCI value now is now 25%, 20% multiplied by 25,000 shares. That gives us the total number of shares the NCI has in the subsidiary. Then you multiply by the share price of the subsidiary. That gives me 6.5. So I get 41,500. Then since I acquired the whole of the equity, 25, the 100%, not 100% though, but we are comparing 100% against 100%. So this is 30,000. So I have 11.5. So the value of my NCI is 6.5. See, the difference between measuring NCI at fair value and measuring NCI at proportionate share is just the fact that when you're measuring NCI at fair value, the NCI, its value will impact on the goodwill. So in some instances, we say he also has a share of the goodwill. You will see that when we measured him at full fair value, you see that the guy is having a much higher value, 6.5, against the previous one where his value was 6,000. And that extra 500 impacted on the goodwill because it increased it also by 500. So that's what we're talking about. Okay, then we consolidated like that. Okay, now following from that, I want to share a question on the group for you. What's the name? I'll share a question with you guys that come in. Okay, I've shared it. So hold on. Let me just bring it here. It was an ICANN pass question. Okay. So if you look at this question, they said the parent company acquired 60% equity interest in a subsidiary company for 440 million. They said the market value of the net asset of the subsidiary on acquisition date was 400. The parent company estimates that the full 100% in the subsidiary company will have cost 640 million. They now say calculate the goodwill at acquisition date, where NCI is measured at proportionate share of subsidiaries net asset and at full fair value. I'll have given you to go and attempt it on your own, but I noticed from my previous assignment that you guys are notorious in not doing assignments. You never do assignments. So I'll be wasting my time asking you to solve it. So they say you should calculate goodwill. Now, again, just the way I taught you, if I want to do it using approach A, proportionate share. So where NCI is measured at proportionate share. So the consideration transferred by the parents, how much did the parent pay for the 60%? The parent pay for 40 million, Abi? Parent paid for 40 million. Then non-controlling interest. So since it's proportionate share, I'll wait to determine my net asset acquired. Now, you will see that the net asset acquired we have been doing so far is ordinary shares plus equity. So some students will say, they didn't give us ordinary shares plus equity. They will have forgotten that I already mentioned that this equity is the same thing as total assets minus total liabilities, which is net asset. Yes, they didn't give us ordinary shares and the pre-acquisition reserves of the subsidiary, but they gave us the market value of the net asset of the subsidiary. It's the same thing. It's the same. This one is even straightforward. You don't have to be looking for share capital. You don't have to be looking for reserves. Which one is pre? They already gave you the net asset at acquisition date, which is 400 million. The net asset acquired, 400 million. They gave us. So at proportionate share, will just be 40% times what? 400, which is 160. So how much, what does that give us? Is that not 600?
Yeah, 600.
600.
So our goodwill is how much? 200. So B, goodwill, where NCI is measured at full fair value. So again, what's the consideration transferred? He paid 440. Now, since NCI is at full fair value now, so again, you will say that they didn't give us the number of shares he acquired now. They didn't give us all of that now. Yes, but they give you something else that can replace that. They told us that the parent company, the final sentence in this question, they said the parent company estimates that the full 100% interest in the subsidiary company will have cost 640. That means the market value of if the parents were supposed to pay for 100%, the fair value will have been 640. I will have paid 640 for it. You know that the net asset is 400. That one is not questioning. But the transaction price, how much you will have paid is 640 for 100%. And they told me that he paid 60%. He paid 440 for 60%. That means the fair value of 40% is 200, which is 640 minus 440. So this one is just 640 minus 440, which is 200. And that gives me 640. My net asset acquired doesn't change to never change. Comes 400. And my goodwill is 240. So I just needed to show you that, just to apply what we have been doing so far. Okay, moving forward. If you look at this question, here we only acquire 75% in the ordinary shares of the subsidiary, and we acquired it in January when ESCO had retained earnings of 77,500. Now they have made my life easier. Rather than looking at, okay, this date is the same day they give me the account, they have already told me the retained earnings of the subsidiary when I acquired him. So I already know what I've paid for. I already know the part of retained earnings that is pre-acquisition. We are now told that the market price of the shares of ESCO just before the date of acquisition is 160 kobo. So that means the share price of the subsidiary before I acquired them is 160 kobo. I'm now also told that PICO values NCI at fair value. It values NCI at fair value. Goodwill is not impaired. I'm now asked to do statement of financial position as at 34th December 2017. Okay, good, fine. Again, don't forget cancellation. I cancelled out this 34,000 against the equity of the subsidiary. Now, the equity of the subsidiary will always be is share capital against not the whole of this retained earnings, but the pre-acquisition. And now the question have told me that out of this 12.5, at the date we acquired the subsidiary, we made 7.5 there. So it's only 7.5 that we paid for, not everything. So we're going to be canceling out against the 7.5. So if I want to do my cancellation for my workings, which I said we can conveniently start calling goodwill, calculation of goodwill, we'll do my consideration transferred. But hold on. Yeah, they told us 75%. So how much did we pay for the subsidiary? We paid 34,000 in the subsidiary. Then I will add my non-controlling interest. Now, in this question, I'll be very careful, otherwise you'll be wrong. The question said that the NCI, PICO values NCI at fair value. Okay, at full fair value. And lucky for you, they already gave me the share price of the subsidiary. So I can easily do the subsidiary, since we acquired 75%, that means the subsidiary is 25%. I'll multiply that by the number of shares in the subsidiary, which is 25,000 shares. So that's 25% times 25,000 shares multiplied by, what's the share price of the subsidiary?
1.6.
1.6. So what does that give us at the end of the day?
10,000.
10,000 naira. Now, this 10,000 naira gives me 44,000. So I will net this off against the net assets acquired. And I'm sure you know that this net asset acquired is the net asset at the date of acquisition, of course. So the share capital of the subsidiary at the date of acquisition is how much? 25,000. It hasn't changed. Then pre-acquisition retained earnings, which the examiner gave me as how much?
7,500.
7,500. So if I add it together,
32,500.
I get 32,500.
100.
So how much is my goodwill?
12,000.
12,500.
Yes.
Okay, let me ask a very reasonable question. Let me see if there is anybody that will get it right. So if the examiner asks you that this 12.5, that you should calculate the NCI share of this goodwill. If they say calculate NCI share of this goodwill, who can calculate it? If the examiner says
I think
calculate
Sorry,
NCI,
that thing is 11.5, not 12.5.
level 5, sir, not 12.5.
oh, thank you very much. Thank you. Okay. So if the examiner says calculate NCI share of this goodwill, how would you do that?
I feel it should be 25% multiplied by the goodwill figure.
No. Very wrong. Nobody. I'm really surprised that none of you can attend that. That means you're not paying attention to this class. So since this is, if this was measured at proportionate share, right, I will have done 25% of 32.5. And that is what will have been here. Right? So it's as good as this is what he paid, canceling out against his own share of this. So everything goes up. Everything. So it won't be contributing to goodwill if you have just done 25% against 32.5. Let me see what it comes to. It comes to 8,125, But when we measured it at fair value, we are saying that okay, he paid 10,000, but the value of 25% here is 8,125. So that means in this goodwill, if I want to just cancel out net fair value of the NCI against his own share here, that means he has paid an extra of 1,875. Because if I just do 25% of this, that means the value of his net assets is 8,125, but he paid its fair value is 10,000. So out of this goodwill, the NCI share is 1,875. Even though we don't reflect that, but I can just ask you for 3 marks, 4 marks like that. So, and I mentioned it last week again, that when NCI is measured at full or fair value, or what the question call, or what they will sometimes call full consolidation method, right? The NCI would usually have a share of the goodwill. His goodwill is inside. But when it is measured at proportionate share, I mean, look at it. All we'll have just done is 25% of this. That is what we'll put here. So he's in and out for NCI. But here is not in and out. He also has a share of whatever you're having here as balance. I just hope I've communicated. It's straightforward, but I mean, depends on your state of mind. Now, having done the cancellation, what is left is just I will do my consolidated retained earnings. I always want to do these workings because I know that why I'm doing these workings is the fact that these retained earnings of the subsidiary is usually shared between the parent and NCI. So it's just better I just work it out to make my life easy. So the way I will set it up, I will do PICO and ESCO. So I will say at the date of consolidation, or I can say, bless me, I will say, or I can say as per question, as per the question, either one that you like. I'll say the retained earnings of the parent 35, this guy 12.5. So 35, 12.5. So I would first take away the acquisition retained earnings. That one has been cancelled out here. And cancel that up here. So I get 7.5. So the remaining, which is what will remain, no? That should be 5,000. Sure, I'm correct. So this guy will just get share of ESCO's post acquisition. Let me call it share of ESCO post acquisition retained earnings. So it does 75% times 5,000. What does that give us?
3,750.
That's 3,750. That means the total is how much? 38. That's 38,750. Then finally, I can do my NCI as well. NCI. So value of NCI from here, just come and pick it from here. Whatever you have already done it here, which is 10,000. Then you also get share of ESCO's post acquisition retained earnings. So you get 25% times 5,000, which is the balance. That's 1,250. So the guy gets 11,250. And that's all. There is nothing else to cancel here. So he can then go ahead and prepare his consolidated statements of what? Financial position. As at when? As at 31st December 2017. So assets, non-current assets. What is the level of rounding off? Okay, just narrow. So the first item is PPE. I'll add these two together. That's 55,000. The second item is investment in ESCO, which we cancelled out here, giving us a balance of 11,500. Then I have my current assets. I add this together. When I add these two guys together, and can somebody help me add it? 26,000 plus 17,500. 43,500. Then, what's my total assets?
110.
My equity liabilities, equity first. I have my ordinary share capital. I go back to my statements. Okay, so this has been cancelled out. Whatever balance is NCI, so you only consider this as ordinary shares because the balance in the subsidiary is now called NCI. So this is 50,000. Then retained earnings. We already did workings for this. That's workings 2, which is 38,750, which we call consolidated retained earnings. Under workings 2. Lest I forget, this is my workings 1. Then before I go to liabilities, let me bring in my NCI because NCI is the remaining part of the equity of the subsidiary. So now controlling interest, which is workings 3. And how much is it? 11,250. Okay, if you add this together, what does it give us?
100,000.
100,000. Then I go back. Then remaining my current liabilities, I add this to, it gives me 10,000. So my total equity and liabilities is how much? 110,000. Okay, so similar, nothing different from the simple ones we have been doing, but now I thank God that I already set you up from the beginning to do this, right? And the fact that I need to properly share these retained earnings of the subsidiary after taking out the one we have cancelled out, then NCI from my setup up here, I pick up NCI value. Then he also share in the retained earnings because he's a part owner, so he gets a share. And I also made the point that NCI has a share of this goodwill because it's measured at full fair value. That's the only implication of measuring NCI at full fair value. He owns part of the goodwill. So that has to be noted for the purpose of consolidation. So we can move to the next question, but I can see one hand raised up.
That's my answer.
Okay, Latif, please go ahead.
Sir, well done for the job, sir. I just quickly want you to just come back to that of NCI you mentioned, where because we use fair value to value the NCI, definitely the parent and subsidiary will share it. So you tried to explain to us the portion of the share of that of the NCI. So I just need you to re-explain that again before we move forward.
Okay. So what I'm saying is that this goodwill here, that whenever NCI is measured at full fair value, this goodwill, it would have a share of it. Let me show you. Just because you asked, that means a lot of you might not even understand what I was saying. So let's assume the question says NCI is measured at proportionate share. That means NCI will have been 25% times this 32.5. If you punch your calculator, that gives you 8125. Can you add these two together?
46.
125.
Say it again.
42,125.
42,125.
Okay. So how much is the goodwill?
Nine six two five.
9625.
Okay. So the only reason why the goodwill was higher here was because this NCI is measured at full fair value, because the only variable that changed in these two workings is just NCI. So in this first instance, we measured NCI at full fair value. We had an higher goodwill. In this second instance, we measured NCI at proportionate share. We had a lower goodwill. And that confirms or support our assertion that whenever NCI is measured at full fair value, it has a share of the goodwill. So that increase, if you look at the increase in goodwill, that's the one brought in by NCI because it was measured at an higher value. Okay. So yeah, this 9625 completely is because of the parents, because these 8125 NCI parts would be the same thing in its parts here. Because if you do 34,000, which is what the parents paid for, I think 75%. If you do 75% of this, whatever you get, if you get the deduction, it gives you exactly this 9625. So NCI is just, since we are doing it at proportionate share, is in and out. It doesn't have a share of the goodwill. But when you do it at fair value, you will definitely have a share. Latif, did that help?
Exactly, sir. Thank you so much, sir.
Okay, good. Okay. Let's look at the next question. Now, if you look at this question, Pico again acquired 75% of the ordinary shares of ESCO on 4 January 2017 when ESCO had retained earnings of 75. And Pico values NCI at proportionate share of subsidiary in its assets. Goodwill is impaired by 20%. So when they tell us goodwill is impaired, that means you need to reduce your goodwill by 20% whenever you calculate it. So this is exactly the same thing as what we did initially. So in order to save a little time, let me just, because it will give us the same thing here. Let me see how NCI is measured. Oh, okay, it's not the same thing. NCI is measured at proportionate share. Okay. So workings, 1, goodwill. So the consideration transferred, how much did he pay? He paid 34,000. Then NCI, non-controlling interest, is measured at proportionate share. So I hold on. Let me get my net asset acquired at the date of acquisition, which is my ordinary share capital. What's the ordinary share capital of the subsidiary? 25,000. What's the pre-acquisition retained earnings? They told me it's 75. 75. When I acquired the subsidiary, his retained earnings was 75. So the addition of the two is 32.5. Now I can get my NCI proportionate share, which is 25% times 32.5. I think we did that the other time. It gives us 8125. So if I add these two together, I think we said it gives us 42,125. So what do I have? $9,625. 9,625. Now they told us that there was an impairment of goodwill. By how many percent? Okay, they said by 20%. So we simply do 20% times 9,625. Does that give us?
1925.
1925. So what's the balance of the goodwill?
7,700.
Okay.
700.
Okay, good. Now, number 2, my consolidated retained earnings, I will set it up Pico Esco. As per question, what's the retained earnings of Pico? 35,000, and that of Esco 12,500.
32,500.
No, you're not adding it together here. It's 12,500. Then pre-acquisition retained earnings, which is 7,500. And you know that the only reason I'm doing this working is just so that I can share this guy's, I can share his profit that is remaining between the parent and the NCI. I hope you remember that everything has a reason. I'm not just setting up workings just for setting up sake. No, it's just to make things easy for myself. However, before Joseph, there's no time I will not remove you. Then there was an impairment of goodwill because the goodwill was impaired. Now, this goodwill that was impaired now, or 1925, whose book is it going to impact? Will it be the parent's books or the subsidiary's book? Who can tell me?
It
Who's
is
the
think
parent
parent?
is
alone.
I think it's the parent.
The parent alone.
Okay. Why the parent?
Since we value goodwill as a proportionate share of net asset of the subsidiary. So
Do you
that
mean
goodwill
a
belongs,
valued NCI?
sir.
You mean that since we value NCI at proportionate share, is that what you mean? Not you say since we value goodwill at proportionate share.
No,
Yes,
not
since we
goodwill.
are valuing the goodwill
Yeah.
using proportionate share, which is partial goodwill, it will only affect the goodwill of the parent company because it's
It's
only the
not
parent company.
it's not the goodwill we are valuing at proportionate
The
share.
Yeah,
value
NCI,
yes,
N
yeah.
NCI.
NCI, sorry, NCI.
Okay, good. Okay, so you understand the fact that this goodwill belongs to the parents alone. So this impairment is an expense to the parent. So 1925 as an expense to the parent. Okay, so let's get his share of post acquisition retained earnings, which is 25% times 5,000. How much is that? 3,750. So what's the total there? 35 minus 1925 plus.
So sorry, why are you using 25%?
Oh, should be 75, not 75. So how much is that?
Now, since it's 75.
Sorry? Yes, sorry now.
That
You
is
people
Sorry,
eight
sir.
talk.
to five.
Sorry, is this figure 50,000 or 5,000,
It's
sir?
5,000.
5. Mhm.
Okay. Boss, I can see your question. Can you don't want to talk where you are? So why are we canceling the goodwill from retained earnings? We are not canceling the goodwill from the retained earnings. We are only removing the impairment of goodwill from the retained earnings of the parent because impairment of goodwill is an expense. It will be expensed. So I just don't want to start introducing double entry. The double entry for this impairment is you are crediting goodwill and debiting the P&L of the parent. That's the double entry for this impairment. So that's why is reducing the retained earnings of the parent because it's a reduction from profits. It's an expense. And that was what I was asking that whose retained earnings should it impact? Should it be the parent or the subsidiary? So since this goodwill belongs solely to the parents, because this NCI is measured at proportionate share, and that's why this impairment was solely deducted from the parent. So we are deducting the impairment, not the goodwill, from the retained earnings. I hope I answered your question. So the next one, which is question 3, is non-controlling interest. Again, we had already set a foundation for determining NCI, which is this. We already determined it as 8125. So value of NCI 8125. So he will get his own share of ESCO's post-acquisition retained earnings, which is simply 25% times 5,000. This 5,000. This post-acquisition. So, and I mean, I can continue to explain to you that the only reason why I'm doing this was so that it's just because of to make it easy for me to share whatever is remaining of the profit of the subsidiary that I did not cancel out. So remember, this 75 is pre-acquisition. I've canceled it out against the money that I paid for the subsidiary. So this remaining 5,000 has to be shared. So NCI is getting his own share of it, and he gets 1,250. So if you add this to that, what does that give us?
9,375.
9,375. Okay. So having set the foundation solid, then PICO consolidated statement of financial position as at year ended, which period? Yeah, 31st December 2017. So I have my assets, I have my non-current assets. So the first item here is PP. And if I add these two together, it gives me 55,000. Then the second item should be my goodwill. And my goodwill is now how much? 7,700, because this investment has been cancelled out. That's the balance is the goodwill. So 7,700. Then going back to my statement, the next item here is current assets. And if you add these two together, what does it give us? That's 43,500. Then my total assets. Can you please add that together for me?
$106,200.
Okay. All right. So next is my equity and liabilities. So my equity, I have my ordinary share capital. What's my ordinary share capital? The correction, that will be the ordinary share of the parents, because the balance in the subsidiary is now NCI. So it's only this 50,000 will bring. Then I will have my consolidated retained earnings, because the next item here is retained earnings. And I've already made life easy for myself. I've worked it out here. Okay, 36,825. Then I can then bring in NCI. So an NCI is 9375. Unless I forget, this workings one. This workings two. Workings three. Okay, can you please add this three for me?
$96,200.
96,200. Is it 200 or 400?
It's 96,200.
Okay, thank you, Bose. Then my current liabilities is 10,000. So my total equity and liabilities is 106. Is 106,200. Okay, so pretty straightforward question, nothing different from what we have been doing so far, except this impairment of goodwill that we had to remove from there, and also graciously removed it from parent retained earnings. Okay, the next one is the same question. You can see, because we acquired the subsidiary in January, retained earnings of the subsidiary was 75. The market price of the subsidiary is 1.6. Pico values NCI at fair value, and goodwill is impaired by 20%. Okay. This one is the same as that. So for that reason, I would,
Assignment.
yeah. So I think you should go and try this. But before you try it, can you tell me what's the difference between what would change here? What would change
Both
here?
the parent and the NCI will share the value of the impairment loss.
Okay, why?
Full
Because the
value.
goodwill
It was mentioned as full value.
Okay, so that means the goodwill belongs to the two of them. So that means this impairment. So how would you then share it? How would we? So if let's say, so if let's say, let me just do what I have to do. So 25% times 25,000 times 1.6. So what would this result to? What would that give us?
10,000.
10,000.
Okay. So this becomes so what's 44,000 minus 32.5? Is that 11.5?
Level 5.
Okay. So what's 20% of 11.5?
2,300.
Okay. So what's the balance?
92.
Okay, good. Now, the retained earnings, let me just copy it. So I have to do the same thing over and over again. Now, the retained earnings Okay. Now, these impairments of 2, 3 now. That means instead of it here, in order for us to share it between this parent and the subsidiary, you set it up here, Abi? 2, 3. So that instead of sharing 5,000, they will be sharing a reduced amount. Since this retained earnings, since impairment of goodwill belongs to the parent and the subsidiary, so that's the easiest way for you. So they get to 7. So this guy, instead of 5,000, he shares really 2,700 because. So then what will be the balance here?
2025.
2025. So this will be 37,025. So NCI here, how much was the NCI up there? It's 10,000. This will be 25% of 27.
675.
That's 675. And that gives me how much? 10,600.
10,000.
So my statements, goodwill is now 92. Goodwill is now 92 from Watkins 1 year. So this one will change. How much will this be now?
107,700.
107,700.
Okay. This one is now 37,025. While NCI is 10,675. So this one will change.
97,700.
96,
97,700.
97.
700.
Okay, so this is 107. 107,700 still. Okay. So problem 11. Okay. Now, for this question, the same thing. We acquired ESCO on 4th January 2017. Retained earnings was 75. Market price of the subsidiary was 1.3 before the date of acquisition. We value NCI at fair value. Goodwill is not impaired. And that's it. So let's do some calculations. So holy goodwill, consideration transferred. How much did I pay for the subsidiary? I paid 24,000. Non-controlling interest, that's 25% times how many shares does the subsidiary has? 25,000 shares. And the share price is 1.30 kobo. 1.3. So how much is that?
8,125.
1,125. So what's the addition?
32.
32,125.
Okay. So the net asset acquired I have my ordinary share capital. How much is the ordinary share capital of the subsidiary? That's 25,000. Then pre-acquisition retained earnings, which is 75. So that's 32,500. There's a difference of how much? That's, I think, should that not be 375?
375.
Okay. This one, 375
Negative.
cannot be goodwill. So what name do we call it?
Gain.
Gain on
Gain on
bargain.
bargain.
Yes. So this should be a gain on bargain purchase. So let me give you some, they can ask it in the exam. Know that when there is a gain on bargain purchase, the parents must reassess the following. Number one, the basis of the net assets acquired in the subsidiary, the basis of the measurements of the asset acquired in the subsidiary. Number two, basis of the measurements of the NCI, and also the correctness of the consideration transferred. So the thing is that it's looking at it that, why will I pay lower? That is not possible. That is usually a mistake, because this is, it's not possible. Even though it's possible, but we are looking at it that, okay, except if it is clear that we know that this subsidiary is a company that is almost gone. But even at that, nobody will pay lower than your floor. Your floor value is your book value. That's the floor. So we don't expect anybody to pay below that for your company. So we are saying, okay, go and check how you have measured those assets again. Go and check how you have measured NCI. Go and check the amount we wrote as consideration transferred. Let's check all of those elements again to see that they are correct. So if you find any error, you don't have to come and recalculate this. Just get whatever difference, go and put it to P&L. You don't have to come and be calculating this again. You have calculated it, you have recalculated it. If there's any differences you got in measurement and all of that, take them to P&L straight on. And that's a major part of this question here. So the second working is consolidated retained earnings for PICO and for ESCO. So as per this question, what is the retained earnings of PICO? Okay, 35,205, almost the same thing as the last one. Then you remove pre-acquisition return earnings. What's the pre-acquisition return earnings? 75. Then you add gain on bargain purchase. Who has this gain on bargain purchase? Where will you put it?
The parent.
This is gain. Then you will get share of ESCO's post-acquisition return earnings. Which is 5% times how much? Times 5,000. That's 3,750. So what's the total?
Thirty-nine one two five. 39,125.
What's the value of NCI? It was 8125 from up here. Then you will get share of ESCO's post-acquisition return, which is 25% times what? Times 5,000. How much is that? 1,250. So what's the total here?
9,000.
300. Okay, I think it's the same question as this. So let me just change some figures. Is it 36? No, it's not the same question. Okay, so in this case, we don't have goodwill. So dash. But we have PP, and our PP was 55, the same thing. What's the addition of these current assets? 36 plus 17.5.
53,500.
53,500.
Okay. So I think this should give us 103,500. So what's my ordinary share capital? Yeah, 50,000. My consolidated retained earnings, 39,125. So this 39,125. My NCI.
That total asset is 108,500.
Okay, thank you very much, Nika. So my NCI is 9375. So how much is this now?
Ninety-eight 500.
Well, this still remains 10,000 for my current, yeah, this 10,000. So this 108,500. Okay. let's stop here for today. Tomorrow, see how far we can go. See how far we can go. Hopefully, we'll be able to solve all of this so that we know that we are
Sir,
done with it. Yeah, I'm with you.
yes, sir. Sorry, sir. I don't know. Is our morning class tomorrow holding?
Yes, so it will definitely would
Oh,
till it
all right, sir.
yeah, it's form up stop.
Okay, sir.
Bye, see you later. Bye bye.
All right, sir.
Thank
Thank you, sir.